Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And with the explosion in the use of artificial intelligence throughout the world, you've probably wondered whether AI can help you to improve your trading profitability, but you don't know where to begin to try to figure that out. Well, if that's a good description of you, then you're going to want to stick around for the rest of today's video, because we're going to be sharing with you an example of how one trader who closely follows SMB used ChatGPT to create a massive improvement in his zero DTE options trading. There's some really important lessons to be drawn from today's video, so let's get going. If you're absolutely brand new to options trading and you don't know much about how options work, we've created a video for you to understand options basics. So if you click the video appearing on your screen right now, that's going to lay the groundwork for you to understand the option strategy we're going to be discussing in today's video. Then when you're finished, you can come back and watch the rest of this video. First off, we're going to share with you this strategy that he's trading using zero DTE options, which are options that expire at 4 p.m. Eastern time on the day that you're executing the strategy. So these are obviously very quick trades because they can't logically last more than a day. And in fact, in this case, only lasts 2 hours. So let's dive into a recent example, which will make the trade clear. So in the middle of this month, on July 16th, as you can see, the SPX index, the index comprised of 500 large cap US stocks, gapped open at around 62.55. And so the way that this trade works, at the opening bell, the trader pulls up an options chain expiring that same day, July 16th. So it's a zero DTE options chain. And then the trader proceeds to construct what options traders refer to as an iron condor trade, which in this case will express no bias as to what the direction the index will be headed that day. In other words, the trader is indifferent to whether the index goes up or down. In fact, the less movement the index makes, the better, as you're going to understand in a minute. And so the first step is for the trader to look at that column called delta on the options chain, which is a column that will appear in your broker's options trading platform. And he's going to find the call option with a delta closest to the 30 delta option, which in this case is the 62.70 call with a delta of 29.93, and he's going to go ahead and sell 3 of those 62.70 calls, for which he receives a price of $5. And he's also going to go ahead and buy 3 of the 63.40 calls 70 points higher for protection, paying a price of 7 cents. And by doing so, he's created what options traders call a 30 delta call credit spread. And then simultaneously, we move to the second step of constructing an iron condor, which is for the trader to sell a 30 delta put credit spread, where he'd sell 3 of those 62.40 puts, which are again the closest to 30 deltas. They have a delta of 29.36, and simultaneously he'd buy 3 of the 61.70 puts, 70 points lower this time. And so that full combination, a call credit spread above the market and a put credit spread below the market, that entire combination is what options traders call an iron condor. And in this case, a 30 delta iron condor, because we sold both the 30 delta calls and the 30 delta puts and surrounded them with protective long calls and puts 70 points farther away from the market. Now, before we go any further, you may be wondering why we picked those 30 delta call and put options to sell, and that's very important, so we're going to take a minute on this before we go on. You see, the delta of an option is a mathematically arrived at prediction of how much an option's price is likely to move based upon how much the options index itself moves. And while it's a bit of an involved topic, suffice it to say that options deltas also have been found to be correlated to the probability that an option will expire with value on the day that it does expire. And so, for instance, in the case of a 30 delta call option, there's an approximate 30% chance that the index will close above that call option strike price on the day that that call expires. And so if you think about it, it also means there's a 70% chance of the index closing below that call strike price on expiration day. And when does an index call have value on expiration? Only if the index closes above that call strike price, because index call options only pay off if the index closes above the call strike price. And the exact same thing is true for the 30 delta put option, except to the downside. And so the options market is saying there's a 30% chance the index will close below the put's strike price of, in this case, 62.40, and therefore a 70% chance that it will not expire below that price. And so what we're trying to do here is to sell options, all of which have less of a likelihood of expiring with value than with no value. Now, why would that even be a goal of ours? Well, to understand that, let's first focus on what's happened here from a cash flow perspective. And so starting with the call credit spread, you could see that we sold that 62.70 call for a price of $5, but index options pay off at $100 per point, so you multiply that by 100. And we sold 3 of them, so when you multiply it all together, you receive cash from selling those 5 calls in the amount of $1,500. But then you turn right around and pay out $21 for buying those 3 protective calls up at 63.50 using that same kind of calculation. Then, simultaneously, we sold those 3 62.40 puts, bringing in $1,650, as you can see from the calculation, and paying out $111 for the 3 protective 61.70 puts. So when you net it all down, it results in positive cash flow of $3,018, as you can see from the calculations, for which your broker, incidentally, will require you to have at least $17,982 in your account to execute this trade using a 3-lot trade size like we did here, because that $17,982 represents the worst case scenario loss on this trade. And so as you can now understand, since we're paid cash upfront for entering the trade, we are more than happy to see all of those options expire worthless at the end of the day, because if that happens, then we just collected $3,018, which we can just keep as our profit, because if they all expire worthless, then none of the options pay off anything, and our profit is the cash we got when we first entered the trade. So now you can see why we tried to select options that are more probable than not to expire worthless. And so the protocol that this trader follows is that just as soon as the trade can be closed for profit of 25% of that cash he got in the first place, which in this case is $755, he'll close the trade for a win. But if the trade never reaches that profit level by 11:30 a.m., he takes the trade off regardless of its P&L at that point. So it's at most a 2-hour trade. But if the profit target's hit, the trade will be less than 2 hours. Okay, so now let's move to 10:30 that morning, and after opening at 62.55.82, the index pulled back a little bit, trading at 10:30 at 62.47.43. And so the way that you close an iron condor trade is to simply reverse the original transaction. In other words, you buy back the options you sold and you sell off the options you bought. So let's see what the outcome of the trade would be if we made the decision to close the trade at this point. Well, as you can see, the 62.70 calls, which you'll recall were sold for $5, have shrunk down to $1.62, a drop of $3.38, way below what we sold them for, whereas the 63.40 calls we bought for only 7 cents had not yet moved in value. Now, the puts we sold at 62.40 had gone up somewhat, now trading for $6.25, which is an increase of $1.25, whereas the puts down at 61.70 had actually dropped a nickel down to 32 cents. And since almost all the premium in this trade involved the calls and the puts we sold, the really important thing to focus on here is the price movement of those 2 short options, with the short calls losing $3.38, while the short puts gained value but only $1.25. And so what's going on here is that these options are going to expire today. The options lose value quickly during the day because there's only 1 day left, particularly if the index hasn't crossed past the strike price of any of the options, which it has not in this case, because at that point, the market has less time than it did at the open to make up the difference and reach that options price. So when the market moves away from the call strike prices like it did here, those calls lose tons of value because the market now has even farther to go to give them any value at all at the end of the day, and there's less time left in the day. Whereas the index actually moved towards the put strike prices, and they did gain value, but because they didn't reach those prices, the index still has to sell off further to hit that strike price and give it value at the close, but there's one less hour for that to happen. And so that is why the put option went up, but by less than you might have thought, because while the index made progress towards hitting that put, there's now one less hour left in the day for the index to do that. So it gains value, but not a lot, because of what options traders refer to as time decay, which is the way that the passage of time devalues options prices, especially on the day they expire. So let's hypothetically calculate the trade's profit were we to close the trade at this point. Now, of course, we start with the fact that we've collected $3,018 at the outset of the trade. Don't forget that, because that's going to be our profit engine. And then after that, as we said before, we're just going to reverse the opening transaction, buying back the 62.70 calls at their current price of $1.62, which, as you can see from the calculation, costs us only $4.86. And then you can see that we sell off the long calls for $21, buying back the short puts for $18.75 and selling off the long puts for $96, resulting in a final trade profit of $774, which exceeds our profit target. And thus at 10:30, we'd exit the trade above target. But let's suppose that instead it was a morning where the trade didn't work. Let's suppose that by our mandatory exit time, the trade had not reached its target profit, but instead the index was trading at 62.3435, like it was at this point in time that day, where the index had now traded down through the short put strike price and was trading more than 5 points below that. While focusing on the short calls, of course, those have gotten even cheaper, now trading for 77 cents on the short calls. But now the short puts have ballooned up to 14.40, and even though the long put also increased from its original 37 cents to $1.07, obviously the short put has exploded. Well, if we were to have exited at this point, again, starting with the initial positive cash flow, subtracting out the cost of buying the short calls back for $2.31 while salvaging only $6 from selling the long calls, and then most significantly being forced to buy back the long puts for $43.20 because the price had skyrocketed after the index passed through that put strike price, and finally adding back what we sold the 61.70 puts for, the result is a loss of $1,206, driven almost exclusively by that huge cost of those 62.50 puts. And so at this point, and really the whole reason for this video actually, is to discuss what happened next in this trader's journey. And that is that he decided that while the trade strategy was solid, with a solid win rate and solid profitability of traded every day, he wanted to see if he could come up with a way to cut down on the number and magnitude of losses that he was seeing in his backtest on the strategy, to improve the win rate and make the trade even more profitable. Well, in order to do that, he had to ask himself, what makes this trade profitable on some days and unprofitable on others? And the obvious answer is that on days when the market moves a lot in the morning after he puts the trade on, then he tends to lose those trades. Whereas if the market is relatively still, then he tends to win those trades because the market keeps devaluing the options as they move closer and closer to expiring. And if the index doesn't move too close price-wise to either the short calls or the short puts, they should lose a lot of value also and provide him with a win. So the real question is there any way of predicting those days when the market is likely to move a lot and then to avoid those days? And so he did something really smart at that point. He went ahead and fed into ChatGPT the dates that he had losses, and he asked the program to tell him what was going on those days, and specifically what scheduled economic reports tended to cause so much movement that they wrecked the trade and caused a loss. Now remember, every month there are dozens of economic reports issued by public sector and private sector entities that the whole market pays attention to. If you're serious traders, you're going to know, for example, that every 6 weeks, the Federal Reserve's Open Market Committee meets to discuss the economy and set target interest rates, as well as hold a press conference that elaborates on those decisions. Each month, the Labor Department releases the crucial non-farm payrolls report. Each month, CPI, PPI, GDP, PCE, the Fed's favorite price indicator, unemployment claims, durable goods inventories, and so on. There are dozens of them. And so this trader asked ChatGPT to zero in on the days that the trade lost and to determine which reports and events tended to wreck his trade. Now, we're not going to get into which reports he discovered because we want to honor the hard work he put into this project, which took him more than 3 solid weeks, by the way, but suffice to say that he got some pretty clear answers from that simple question to ChatGPT, and he was able to pinpoint which days he absolutely will not take this trade because one of those dangerous reports is scheduled to be released that day. Once he then identified the days to take the trade and the days to avoid the trade, he began to trade it live with real capital. And on the days he didn't trade, because one of those major economic events was scheduled to occur, one of the dangerous ones, he used software to simulate the trading of that strategy to see what the outcome would have been had he traded it every day and ignored the dangerous economic events. And so it probably isn't surprising that he observed the following. Given that he would have traded it every day had he not employed the economic event filter, he noticed that he was not trading the strategy on 25% of the days that the market was open. But that paid off because he noticed that the win rate without the economic event filter was 62%, while the win rate with the economic filter was 86%, more than a 1/3 improvement in win rate. And far more importantly, the trade's profitability more than doubled, even though he was trading it less often. And that, of course, is the sign of a really good trader. As we say in baseball, the best hitters know when to swing and know when to lay off a pitch. Those hitters will be the most successful in the long run. And so what I'd like you to take away from today's video is that the hard work of becoming a competent trader can be made powerful and less time-consuming through the use of modern tools now available to us like ChatGPT, with more software being developed every day that will make things even more powerful in terms of data analysis and artificial intelligence. To separate yourself from the pack and find edge, you're going to need to gain insights into what is making your trading successful and what factors are hindering you, and then focus your efforts on trading on days when the optimal conditions are there for you to succeed. That's how great traders hone their playbooks, and that's going to be very important for you in your personal trading journey moving forward.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.